Folks, are you looking for a stock that have every reason to explode? Then this video is for you. Because in a world where global tensions continue to escalate and military modernization becomes a top priority for world powers, defense stocks are quietly becoming the unsung heroes of long-term investing. So today we are diving into 3 defense stocks that have the potential to make you rich if you get in before Wall Street fully prices in their future value. These are not random stocks picked off a list. These are companies backed by solid fundamentals, visionary leadership, massive government contracts, and unwavering support from the biggest analysts on Wall Street. So if you're serious about making money in the stock market, make sure to watch till the end and remember to subscribe and turn on notifications so you never miss an update on the hottest stocks in the market. First on our list is RTX Corporation, a powerhouse born from the 2020 merger of Raytheon and United Technologies. This merger didn't just create a bigger company, it formed a behemoth with deep roots in both commercial aerospace and military defense. RTX operates through 3 core businesses: Collins Aerospace, Pratt & Whitney, and Raytheon. While the first 2 serve the commercial airline and jet engine markets, the third, Raytheon, is a name synonymous with advanced defense technology. Raytheon delivers radar systems, surveillance technology, missile guidance systems, and some of the most critical cybersecurity and software services used by the U.S. Department of Defense and intelligence community. Whether it's powering missile detection systems in hostile zones or supplying digital infrastructure for national security networks, RTX is right at the center of modern warfare and security operations. RTX recently reported sales of $20.3 billion, reflecting a healthy 5% increase compared to the same period last year. But if you remove the noise of divestitures and focus on core operations, organic growth actually rose by an impressive 8%. The company's GAAP earnings per share landed at $1.14, which includes adjustments tied to past acquisitions and restructuring costs. On an adjusted basis, earnings climbed to $1.47 per share, marking a 10% increase from the prior year. These figures show solid upward momentum and operational efficiency despite economic turbulence and inflationary pressure. Free cash flow reached $800 million, while operating cash flow was $1.3 billion, numbers that give RTX the flexibility to continue innovating while also rewarding shareholders. Speaking of which, the company returned $900 million to its investors through dividends and buybacks, reinforcing its commitment to shareholder value. One of the most eye-popping figures on RTX's balance sheet is its total backlog, which now stands at an extraordinary $217 billion. That includes $125 billion in commercial aerospace orders and $92 billion in defense. This backlog isn't just a big number. It represents guaranteed, long-term revenue from contracts already secured. As of now, RTX stock is trading at $156.81, and 15 Wall Street analysts give it an average price target of $163.93, with a high of $182. While that reflects a modest 4.54% upside on paper, the real story here is long-term growth and value compression. RTX trades at a discount relative to its peers, and according to analysts like Christine Liwag, that undervaluation makes RTX the single best pick in the aerospace sector today. Next on our list is the iconic Lockheed Martin Corporation, the name behind many of the most advanced and recognizable defense technologies in the world. Lockheed Martin is not just another defense contractor. It is the largest military contractor in the United States and one of the most strategically essential companies in the global defense ecosystem. From the F-35 Lightning II fighter jet to missile defense systems like THAAD and Patriot to its work on NASA projects and satellite systems, Lockheed's portfolio is both deep and wide. It also produces the Black Hawk and Seahawk helicopters, essential tools in U.S. and allied military operations. Beyond hardware, Lockheed also specializes in integrated mission systems, cybersecurity platforms, and cutting-edge surveillance systems used by every major U.S. military branch. Even with such a dominant role, Lockheed's most recent financial report shows a company in full control of its business and confident in its future. Revenue for the latest quarter reached $18.0 billion, reflecting a 4% year-over-year increase. Net earnings came in at $1.7 billion, or $7.28 per share. This level of profitability is exceptional in any sector, but especially in defense, where margins are tight and contract execution is paramount. Cash flow from operations hit $1.4 billion, with free cash flow totaling $955 million. The company also returned $1.5 billion to shareholders via dividends and stock buybacks, showcasing its ability to generate excess capital even after funding advanced research and development. Although the company surprised the market with a $1.6 billion pre-tax charge tied to a classified aeronautics program, top analysts, including Christine Luag, argue that the market has overreacted and the dip represents a major buying opportunity. Currently, Lockheed Martin is trading at $421.01, while analysts give an average 12-month price target of $476.87. Some bullish analysts even see it soaring to $600. That average target suggests a 13.9% upside from current prices, which is especially attractive when paired with Lockheed's historical dividend stability and low beta. Even during turbulent market conditions, Lockheed remains one of the most reliable and rewarding stocks in any portfolio. With its long-standing contracts, consistent earnings, strong share repurchase program, and foothold in future-focused technologies, Lockheed Martin is not just a great defense stock, it's a generational wealth builder. Last on our list is Transdig Group Inc., an often overlooked but incredibly powerful aerospace component manufacturer that commands unmatched pricing power in the industry. Unlike the other two giants we've discussed, Transdig doesn't build planes or missiles. It builds the specialized parts that make them work. This includes ignition systems, pumps, valves, gears, motors, and even proprietary fasteners. About 80% of Transdig's revenue comes from products where it is the sole source supplier, meaning no competition and massive margins. Transdig plays a vital role in both commercial and military aviation, supplying original equipment to aircraft manufacturers and aftermarket parts to airline operators and military services. According to analysts, the company's strong bookings and growing aftermarket demand make it one of the most attractive plays in the aerospace sector. Financially, Transdig is an absolute juggernaut. The company reported quarterly revenue of $2.15 billion, up 12% year-over-year, and just a shade below analyst expectations. More importantly, adjusted earnings per share came in at $9.11, beating forecasts of $8.95. EBITDA was $1.16 billion for the quarter, representing a margin of 54%, a figure that most industrial companies could never dream of. The company reiterated its full-year revenue guidance of $8.85 billion and maintained its full-year EPS guidance at $36.47 per share. EBITDA for the full year is projected to hit $4.69 billion, and the company's operating margin remains an astonishing 46.1%. These are world-class metrics that reflect exceptional operational discipline and pricing power. In addition, organic revenue increased 6.9% over the past year, following an even more explosive 16.1% growth the year before. With a market cap of $82.59 billion and a tightly held float that includes large institutional investors, Transdig continues to be a darling of the smart money crowd. At the time of recording, the stock is priced at $1,585. Wall Street analysts have an average 12-month price target of $1,644.67, with the most bullish projecting as high as $1,795. Even though that reflects a modest 3.76% upside, the real play here is on the consistency, margin strength, and long-term compounding of returns. For investors willing to buy quality at a premium, Transdig is the type of stock that can quietly deliver multi-bagger results over time while avoiding the volatility of trendier sectors. Well, that concludes our list of 3 defense stocks with explosive potential and rock-solid fundamentals. Whether you're looking for massive government contracts, reliable cash flow, or quiet but powerful long-term compounding, these companies have it all. RTX brings scalability and cyber defense dominance. Lockheed Martin delivers unmatched reliability, military innovation, and shareholder returns. Transdig offers unbeatable margins and monopoly-like control over specialized aerospace components. If you're serious about building wealth through smart investments, defense is the sector you can't afford to ignore right now. Make sure you do your own research, and if you found this video valuable, don't forget to like, subscribe, and hit that notification bell so you never miss our updates on the most promising opportunities in the market. Stay tuned, and we'll see you in the next one.